Imagine a marketplace where prices don't just climb, they rocket upwards, seemingly defying gravity. This is the essence of a crypto bull run, a period of intense optimism and skyrocketing value that has defined the industry for over a decade. It's a time when stories of overnight millionaires capture headlines, and the fear of missing out becomes a powerful force, drawing in new investors by the droves. A bull run is more than just rising numbers on a screen. It represents a collective surge in belief about the future potential of digital assets, turning abstract technology into tangible, life-altering wealth for some and a source of intense fascination for all. These cycles are the engines of growth, fueling innovation and expanding the crypto universe. These periods of explosive growth are not random. They are often tied to specific events within the cryptocurrency world, most notably the Bitcoin halving. This event, which happens roughly every 4 years, cuts the creation of new Bitcoins in half, making the asset scarcer and, historically, driving up its price. This price surge in Bitcoin, the market's leader, typically creates a tidal wave of positive sentiment that lifts all other digital assets with it. The current period we are in, stretching from now in late 2025 towards the end of the decade, is seen by many as a particularly crucial chapter in this ongoing story of boom and bust, a final, monumental sprint before the entire race changes forever. What makes this particular bull run so significant is the context in which it's happening. Unlike previous cycles that were largely driven by individual retail investors and crypto enthusiasts, this one is different. We are witnessing the grand entrance of the world's largest financial institutions. Giants like BlackRock and Fidelity, who once viewed crypto from a skeptical distance, are now actively participating through new investment products like exchange-traded funds or ETFs. This isn't just a small shift, it's a seismic event that legitimizes the asset class on a global scale, injecting unprecedented amounts of capital and credibility into the market and setting the stage for what could be the most powerful bull run yet. Therefore, this bull run isn't just another cycle of speculation. It represents a critical turning point, a bridge between crypto's chaotic, adolescent past and a more mature, integrated future. The outcomes of the next few years will likely determine how these technologies are woven into the fabric of our daily financial lives for decades to come. For the average person, it's not just about the potential for investment gains, it's about watching a new financial system being built in real time. This period could very well be the last time we see the kind of wild, untamed growth that has made crypto famous, marking the end of its first, most dramatic chapter. Many experts and longtime market analysts are pointing to the 2025 to 2030 period as the potential grand finale for crypto's era of explosive, speculative price surges. The primary reason for this prediction is market maturity. Think of the crypto market like the Wild West in its early days, a lawless, high-risk frontier with the potential for vast fortunes but also immense danger. Over time, towns were built, laws were established, and the frontier became settled. Similarly, the crypto market is transitioning from a speculative free-for-all into a more established and integrated part of the global financial system, as more big money from institutions flows in and regulations become clearer. The wild price swings are expected to gradually diminish. The concept of diminishing returns also plays a crucial role in this forecast. In the early days of crypto, the market was tiny. A relatively small amount of money could cause massive price increases, leading to the 100 times or even 1,000 times returns that early investors dream about. However, as the total value of the crypto market swells into the trillions, it requires exponentially more capital to move the needle. The global crypto market cap already surpassed $3 trillion in 2024, and as it continues to grow, the physics of finance dictate that its growth rate must slow down. It's much easier for a $10 billion asset to double in value than it is for a $1 trillion asset. Another key factor is the approaching limit of Bitcoin's supply. By 2030, an estimated 98% of all the Bitcoin that will ever exist will have been mined. The core narrative driving Bitcoin's price has always been its digital scarcity, a predictable supply schedule that contrasts sharply with the endless printing of traditional currencies. As we get closer to the final Bitcoin being mined, this scarcity becomes a fully realized fact rather than a future promise. While this will solidify Bitcoin's role as a store of value, it also means the supply shocks from halvings like the one scheduled for 2028 will have progressively less dramatic impacts on the market, smoothing out the violent boom and bust cycles they once triggered. Ultimately, the combination of institutional adoption, market size, and Bitcoin's maturing supply schedule points toward a fundamental shift. The period leading up to 2030 is seen as the last window where the market is still small and unregulated enough to support another massive speculation-fueled explosion in prices. After this cycle, the focus is expected to move away from chasing meteoric gains and toward harnessing the underlying technology for its real-world utility. The market won't disappear, it will simply grow up. The era of the crypto gold rush may be coming to an end, giving way to a new era of building the digital economy's infrastructure. Bitcoin, the original cryptocurrency, is undergoing a profound transformation that will define its long-term role in the world. For years, it has been championed as digital gold, an asset that holds its value over time, protected from inflation and government interference due to its fixed supply. This narrative has been the driving force behind its adoption as a store of value. The approval of spot Bitcoin ETFs in the United States in January 2024 was a monumental step in cementing this role, as it opened the floodgates for mainstream financial institutions to allocate billions of dollars into Bitcoin on behalf of their clients, treating it just like any other traditional asset in a diversified portfolio. Looking ahead to 2030, Bitcoin's evolution is expected to continue along this path. As its market capitalization grows and volatility naturally decreases, its function will likely shift from a speculative investment to something more akin to a global reserve asset. Just as central banks hold gold to back their currencies and stabilize their economies, institutions, corporations, and even nations may begin to hold Bitcoin on their balance sheets as a hedge against economic uncertainty. Its predictable scarcity, with over 98% of its total supply mined by the end of the decade, will make it an increasingly attractive and stable foundation for the new digital economy, a neutral settlement layer that is not controlled by any single country or corporation. The mechanics of the Bitcoin network will also change significantly. Currently, Bitcoin miners are rewarded for securing the network with newly created coins, a process known as the block reward. However, after the 2028 halving and beyond, this reward will become increasingly small. To remain profitable, miners will need to rely more and more on transaction fees, the small payments users include to have their transactions processed. This shift is crucial for Bitcoin's long-term security and sustainability. It signals a move from a system subsidized by inflation, meaning the creation of new coins, to one supported directly by its users, proving the network's utility and economic viability long after the last Bitcoin is mined. For the ordinary person, this means that after 2030, Bitcoin may no longer be the get-rich-quick asset it once was. Instead, it will represent a form of digital property, a reliable savings technology in an uncertain world. Its price may still grow, but likely at a much slower, more deliberate pace, similar to how assets like gold or real estate appreciate over long periods. The days of its price doubling in a matter of weeks will likely be a thing of the past. Bitcoin's grand finale in this bull run is not an exit, but a graduation from a volatile speculative asset into a mature foundational pillar of the global financial landscape. While Bitcoin is solidifying its role as digital gold, Ethereum is on a completely different but equally important journey, becoming the foundational technology layer for a new, decentralized internet. If Bitcoin is the world's digital vault, Ethereum is the world's decentralized supercomputer, a platform where anyone can build and run unstoppable applications. Its transformation is less about storing value and more about creating it through utility. This bull run is accelerating Ethereum's evolution, driven by a series of critical network upgrades designed to make it faster, cheaper, and more powerful for millions of users, moving it from a promising experiment to a robust global infrastructure. Major upgrades, like the Cancun Deneb update in 2024 and the upcoming Pectra upgrade in 2025, are at the heart of this transformation. These changes are specifically designed to tackle Ethereum's biggest challenge, scalability. By introducing features like blobs that dramatically lower transaction fees for Layer 2 solutions, networks built on top of Ethereum, these upgrades are making it practical to build complex applications for everyday use. This is paving the way for a future where decentralized finance, or DeFi, Digital collectibles known as NFTs and other blockchain-based services are not just for crypto natives but are accessible and affordable for everyone, without the network congestion and high costs that have hindered adoption in the past. One of the most exciting developments fueled by these upgrades is the tokenization of real-world assets. This means representing ownership of physical or traditional financial assets, like real estate, stocks, or bonds, as a digital token on the Ethereum blockchain. This market has already exploded, growing from $1.5 billion in early 2024 to over $11.5 billion by 2025, with major players like BlackRock using Ethereum to create tokenized funds. By 2030, you might be able to buy and sell fractional shares of a commercial building or a fine art piece as easily as you trade crypto today, all powered by Ethereum's infrastructure, making markets more efficient and accessible. After 2030, Ethereum's success will be measured not by its price in dollars, but by the value of the economy built on top of it. It is poised to become the dominant settlement layer for a vast ecosystem of applications, handling everything from finance and gaming to identity and supply chain management. For the average person, this means interacting with Ethereum might become as commonplace and invisible as using the internet is today. You might not even know you're using it when you take out a loan through a DeFi app, verify your identity with a digital passport, or receive royalties from your creative work, but its technology will be working silently in the background, powering a more open and transparent digital world. As the crypto market matures and, the era of explosive speculative gains in major assets like Bitcoin and Ethereum begins to fade, the focus of investors and builders will inevitably shift. The end of the gold rush doesn't mean the end of opportunity, it just means the frontier moves. After 2030, the primary driver of value in the crypto space will transition from pure speculation to, tangible, real-world utility. Instead of asking, how high can this coin's price go? The more important question will become, what problem does this project solve? This marks a fundamental change in how the market operates, rewarding long-term vision and sustainable business models over short-term hype. In this new landscape, value will be found in the applications and services that are built upon foundational blockchains like Ethereum. We'll see the rise of specialized projects that integrate seamlessly into our daily lives. Imagine a decentralized social media platform where you truly own your data and get paid for your content, or a global remittance system that allows you to send money across borders instantly with minimal fees, bypassing slow and expensive traditional banks. These are not futuristic fantasies. They're the types of utility-driven applications that will define the next phase of crypto's growth, attracting users based on their usefulness rather than their potential for speculative returns. This shift will also change what it means to be a crypto investor. The strategy of simply buying a major coin and holding on for 100 times return will likely become a relic of the past. Instead, investing in the crypto space will look more like traditional venture capital. It'll involve carefully researching and identifying promising new projects that have a clear use case, a strong development team, and a path to adoption. Assets like Ozak AI, which saw a speculative 700 times projection during the current run, represent the high-risk, high-reward bets that will continue to exist, but they'll be part of a much broader and more diverse ecosystem focused on creating lasting technological and economic value. For the everyday user, this new frontier will be far more interesting and accessible. The crypto world will no longer be just a complex financial market. It'll be a collection of useful tools and platforms. You might use a decentralized storage service to back up your files more securely and cheaply than current cloud providers, or participate in the governance of an online community you belong to by voting with tokens. The end of the speculative gold rush is, honestly, just the beginning of the settlement period, where the true promise of blockchain technology, a more open, equitable, and user-centric digital world, finally starts to be built, one useful application at a time. One of the most defining characteristics of cryptocurrency has been its extreme volatility, the wild, unpredictable price swings that can create and destroy fortunes in a matter of hours. For many, this is what makes crypto both exciting and, honestly, kind of terrifying. However, as the market heads toward 2030 and beyond, this volatility is expected to, significantly decrease. The primary reason for this stabilization is the massive influx of institutional capital. When large conservative players like pension funds and insurance companies invest billions of dollars, they bring a stabilizing force. Their trading strategies are typically long-term and far less reactive to short-term news or social media trends, which really helps to absorb market shocks and create a more predictable environment. The growth of sophisticated financial products will also play a huge role in taming the crypto beast. The introduction of Bitcoin and Ethereum ETFs was just the beginning. In the years to come, we can expect to see a full suite of derivatives, options, and futures markets develop around digital assets, similar to what exists for stocks, commodities, and currencies. These instruments allow investors to hedge their bets, manage risk, and speculate on price movements without directly buying the underlying asset. This deepens market liquidity, meaning there are more buyers and sellers at any given time, which makes it much harder for a single large trade to cause a dramatic price swing. Furthermore, as the crypto market becomes more interconnected with the traditional financial system, its behavior will start to mirror it more closely. The days of crypto existing in its own isolated bubble are ending. Its price movements will become more influenced by global macroeconomic factors like interest rates, inflation data, and geopolitical events, just like the stock market. This integration means that while crypto will still offer unique properties, its risk profile will become better understood and more manageable. It will transition from being treated as a fringe, high-risk gamble to a legitimate alternative asset class within a well-balanced investment portfolio. For the average person, a less wild crypto market is, overwhelmingly, a good thing. It reduces the risk of catastrophic losses and makes it a more viable option for long-term savings and investment. Imagine being able to allocate a portion of your retirement savings to digital assets without the constant fear of a 50% crash overnight. This stability is the key to unlocking mass adoption. While the thrill of astronomical gains may fade, it will be replaced by the quiet confidence of a mature and reliable asset class, making it safer and more accessible for everyone to participate in the future of finance. For much of its history, cryptocurrency has operated in a regulatory gray area, a Wild West where rules were few and far between. This freedom allowed for rapid innovation but also opened the door to scams, market manipulation, and uncertainty. That era is, definitively coming to a close. As we move toward 2030, one of the most significant forces shaping the future of crypto will be the implementation of comprehensive government regulations around the world. These rules are no longer a distant threat, but a present reality, and they will fundamentally change how the industry operates, for better and for worse. The primary goal of these new regulations will be to protect consumers and ensure financial stability. Governments are keen to implement robust know-your-customer and anti-money laundering requirements, making it much harder for illicit actors to use cryptocurrencies for illegal purposes. We can also expect clear guidelines on how digital assets are taxed, how crypto companies should be licensed and audited, and what disclosures they must provide to investors. This framework, while potentially burdensome for some projects, will bring a level of legitimacy and safety to the market that is essential for attracting mainstream users and conservative institutional capital. This regulatory clarity will have a profound impact on market behavior. With clear rules of the road, the risk of a sudden government crackdown or an unexpected ban on a particular crypto activity will diminish significantly. This reduction in regulatory uncertainty is a huge green light for large corporations and financial institutions that have been waiting on the sidelines. It will give them the confidence to invest heavily in building crypto-powered products and services. However, it will also likely limit some of the more extreme, speculative aspects of the market. The days of launching an anonymous project with no accountability may be over, as regulators demand transparency and responsibility. For the average user, this means the crypto landscape after 2030 will feel much safer and more familiar. Interacting with a crypto exchange or a DeFi platform might feel as secure as using an online brokerage or a traditional bank. You will have clearer legal recourse if something goes wrong, and you can be more confident that the services you are using are compliant with the law. While some of the rebellious, anti-establishment ethos of early crypto may be lost in this process, the trade-off will be a more stable, trustworthy, and ultimately more useful ecosystem that can finally achieve its potential for mass adoption and integration into the global economy. While the maturation of the crypto market promises stability and wider adoption, it's important to acknowledge the risks and challenging realities that come with this transition. The end of extreme volatility and the arrival of regulation are not a panacea. They introduce a new set of trade-offs. One of the most significant risks is the potential for centralization. The very institutions that bring stability and capital, large banks, asset managers, and tech giants, could also come to dominate the ecosystem. This would run counter to the core decentralized ethos of cryptocurrency, potentially creating new digital gatekeepers that concentrate power and control, much like the traditional systems crypto was designed to disrupt. Another reality of a mature market is the cooling of innovation in certain areas. The Wild West environment, for all its faults, was a fertile ground for radical experimentation. Without strict regulatory oversight, developers were free to build whatever they could imagine, leading to breakthroughs like DeFi and NFTs. As regulatory frameworks become more rigid, the cost and complexity of launching a new project will increase. This could stifle the kind of permissionless innovation that defined crypto's early years, favoring well-funded corporate projects over grassroots community-led initiatives. The challenge will be to strike a balance where rules protect users without strangling the creativity that drives the industry forward. Furthermore, the integration of crypto with the traditional financial system means it will also inherit some of its systemic risks. A major crisis in the banking sector could spill over into crypto markets, and vice versa. During the 2025 to 2030 bull run, the lines between traditional finance and crypto are blurring, creating complex interdependencies that are not yet fully understood. A mature crypto market will be part of the global economic engine, meaning it will be susceptible to the same recessions, interest rate shocks, and financial contagions as stocks and bonds. It will no longer be a completely uncorrelated hedge, but another component of a complex global financial machine. For the average person, these risks mean that even in a mature market, diligence will remain crucial. It will be important to understand not just the technology you are using, but also the corporate and regulatory structures behind it. Is the decentralized service you're using actually controlled by a single company? How would your assets be affected by a crisis in the broader economy? The dream of a completely trustless and independent financial system may need to be tempered with the reality that a regulated and integrated market comes with its own set of powerful intermediaries and systemic vulnerabilities. The post-2030 crypto world will be safer, but it will also be more complex. As the dust settles from the final great crypto bull run, the world after 2030 will look fundamentally different for anyone who invests in or interacts with digital assets. The narrative will have shifted decisively from speculation to utility. For the average person, this means crypto will be less about chasing dramatic wealth and more about using a new set of powerful financial and digital tools in your everyday life. The excitement will no longer come from watching prices double overnight, but from the seamless experience of sending money to family abroad in seconds, earning a yield on your savings that outpaces inflation, or owning a verifiable piece of a digital world. Your financial life will likely have a crypto component, whether you actively seek it out or not. Your retirement portfolio, managed by a traditional financial advisor, might have a standard 5 to 10% allocation to digital assets like Bitcoin and Ethereum, treated as a modern alternative to gold or growth stocks. When you buy a house, the deed might be a non-fungible token on a blockchain, providing an immutable and instantly verifiable record of ownership. You might take out a loan, not from a bank, but from a decentralized lending pool, with terms that are transparent and governed by code rather than corporate policies. Crypto will become part of the plumbing of the financial world. Beyond finance, your digital identity and ownership will be transformed. Instead of relying on a dozen different passwords for every website, you might use a single self-sovereign identity secured on a blockchain, giving you full control over who can access your personal data. When you create art, write an article, or produce a video, you could instantly tokenize it as an NFT, ensuring you automatically receive royalties every time it is sold or used. This creates a more direct and equitable creator economy, cutting out many of the intermediaries that currently take a large cut. This is the promise of Web 3, powered by mature blockchain technology. In essence, life after 2030 means crypto will finally deliver on its core promise, giving individuals more control, ownership, and opportunity. The journey will have been a wild one, marked by incredible booms and painful busts. But the lasting legacy of this final explosive bull run will not be the speculative frenzy it created, but the mature, stable, and incredibly useful technological foundation it leaves behind. It will be a world where the power of decentralized networks is quietly and efficiently integrated into the fabric of our digital and financial lives, making them more open, fair, and accessible for everyone. The boom will be over, but the real revolution will have just begun.